All right, another fun topic, capital gains. So whenever we talk about capital gains, the first thing that we're going to talk about is where you started. Okay? Before we can talk about a gain, we got to talk about what we had. Okay? So tax basis is what we call where did you start and what did it become? Capital gains. Okay? So let's take a look at this. The basis is the cost of purchasing, building, or improving the property. So the verbiage, as you can tell with the IRS, is all very similar, right? If we have a $200,000 original purchase price and you have $5,000 in closing costs and you had to improve the property because there was a fire in the middle of it before they sold it, your basis would be $250,000. So that's the first question that I get a lot when it comes to the tax basis is, do I get to include the renovations that I did? What about the closing costs? Technically, even your commissions are considered a part of the cost basis, right? Because it was used to purchase, build, and improve, right? Your commissions are part of the purchase. It technically becomes part of their tax basis. So when they sell the property, so let's say they hold on to it for, 7 years, and then they sell it for $500,000, the CPA is going to perform the calculation, their current sales price minus the tax basis, including all their improvements and closing costs, and then that would be their capital gains. Okay, so that's why it's showing $250,000. Now, 15% capital gains rate. So this is an example of the 15% capital gains rate, but the reality of it is it's based upon your tax bracket. Okay, so the more money you have, guess what? You got more capital gains. This example, they're using 15% because that's kind of where most people fall when it comes to the capital gains calculation. But this is what it would look like: $250,000 in capital gains times whatever your tax rate is. In this example, we're using 15%. $3,750 is your taxes due at close. And your and unfortunately, escrow will not keep that money for you, right? They're going to give it to you, which means you've got to save it and get it ready to pay the IRS. And that's where a lot of folks kind of go sideways. They make off with their proceeds. They forget that they've got this huge tax payment coming up. And then that's how they get in the hole with the IRS when they find out that now they owe not only their usual tax stipend, but the capital gains on top of that. So this particular person, depending upon what category they may be in, they could be looking at a $50,000 tax bill, right, between their regular taxes and their capital gains.
So I have a question.
Mm-hmm.
Would that gain put you in a higher tax bracket, and then you have to, or so?
Yep, it's income.
Yeah, so if you're in a 15%,
Mm-hmm.
now you have that $1 million gain. Now you go up to a 35%.
Yes,
Okay.
exactly. Mm-hmm.
But that's just your total for that year.
Yep,
Yeah, but that's still.
but that's the year that you're getting
Big
taxed
It
on.
hurts.
Yeah, it's a big deal.
Yep, it is. So that is a great question. Yes, whatever capital gains you received in 2022, if you sold a big house and had a ton of capital gains in 2022, for 2022, you would have made your regular income plus your capital gain income. They would add that together and then tax the whole shebang.
But I believe it's 585 in Hawaii is the benchmark. At least that's what we were told by our CPA. Don't quote me, I'm not a CPA.
Mm-hmm.
That's the benchmark, that's the cap. Like
So
anything over that is.
What she's talking about is this grid right here that we went over earlier. And you have to remember, Hawaii is a state that's SALT, right? We're talking about federal here. And this is also an older grid because this class was generated in 2020. 2023, it is a little bit higher, but this is what she's referring to here, is that once you get over 518,000 for single or filing jointly 622 in this example, then you're at a 37% tax bracket. Okay,
So then you
but
have
that
state-
income figure is higher now.
Okay, but you also have a state tax bracket.
Then you've got state tax bracket on top of that. Because the love keeps coming.
Better off to just die.
Yeah.
What happens after that
We're going to get to estate tax. Don't worry. We're going to talk about that next.
when you die?
They don't stop. Okay, so this is where it tells you about the capital gains. This is where it tells you about the capital gains. This is where it tells you about the capital gains. This is where it tells you about the capital gains. This is where it tells you about the capital gains tax rate. Okay, but look at this: 0% if your income tax bracket. Somebody's phone is going off. So 0% if you are in the 10 to 12% tax bracket.
Okay, that's when you really want to jump off the bridge.
Yep. 15% if you are in this tax bracket, and then everything above that is going to be 20%. Okay, so that's why we say 15%. People say capital gains 15% because the general will fall in that range. But if you're in a higher tax bracket, you're going to be looking at 20% on capital gains. Okay, so when we are talking about capital gains and we're talking about what we're going to do with that property, right, there are three things that you can do. The first thing, which results in capital gains, is sell the property. Okay? The second thing that you can do is gift it to one of your heirs or someone else that you want to gift it to, exactly, or charity, during your lifetime. So we'll look at what that looks like, okay, the gift tax. And then you may want to keep it and pass it to your heirs after you pass away. And suicide, even though it technically qualifies, we don't want that, right? So, at least make sure it's natural. Make sure it's like look to my taxes and like that. That would be the way to do it. But you can keep it tax to your heirs, and that's what we call estate tax. Okay. All right. So let's take a look at some of this stuff and how that works. So this is $500,000 property. $250,000 gain, because remember you sold it for $500, your basis is the $250, so same example from before. If your heirs, if you look at your taxes and pass away, and your heirs inherit your property, they get what is called the stepped up basis.
That's right.
So whatever the current property value is, that now becomes their new basis. Okay? And they don't have to pay any capital gains.
See, that's what I thought.
Yep. But if you gift it to them while you're alive, and that includes looking at your taxes and just being in the ICU, but if you're still alive, then they will get the actual basis the way it is now, and they will be subject to the capital gains. Okay?
So the step-up basis, the 500,000 is just after that?
Yeah.
That is after death. That's in the inheritance stage. So that is where you willed it to them or trusted it to them after your passing. Okay, so principal residence exclusion. This is talking about the exclusion. Okay, so principal residence exclusion. This is talking about the exclusion on your property taxes when it comes to selling your home. Okay, so this is where people talk about live in it the first 2 years, right? So what is a principal residence exclusion? You must live in the home as your primary residence for the last 2 of the last 5 years. Okay, and you do not have to use the proceeds to buy another home. So, and this is coming from back in the day. In order to receive this exclusion, you had to use that property, the proceeds, to buy another home, but you do not have to do that in current day. That guideline changed in the late 80s, early 90s, which is where we actually saw a huge bump in mortgages, debt consolidation, stuff like that, because now you did not have to use those proceeds to buy another home. So how does it work? If you are a married couple filing jointly, then you get up to $500,000 in your capital gains exclusion. So in this instance, if this was a married couple and they sold that property, $500,000 exclusion, they wouldn't have any capital gains at all. So in this instance, if this was a married couple and they sold that property, right, That is why it's so important to move into your home. I was at a conference a number of years ago. There was a very successful real estate agent out of San Francisco. He had a crazy story where, you know, as a kid, he had been in a car accident and he was in the hospital for a couple of years. He recovered from that. He got cancer, and then after all of that negative stuff that happened, he became a real estate agent. He built this entire empire from out of it, and he would always, and during that conference, all he talked about was how he would flip what he called his own primary residence, right? Every 2 years, he moved his family to another place. And sometimes it was always in the same neighborhood, because it doesn't say that you have to move away from your neighborhood or from that school district. You just gotta move next door, right? That's all you literally have to do, is leave one house and move to the next house, and then you can meet this primary residence exclusion. So he was buying multi-million-dollar homes, fixing them up, selling them, and getting away with paying no capital gains because of this primary residence exclusion. So it can be a very powerful tool as an investor if you know how to leverage it. For single filers, you have $250,000, and that would work for single individuals or for a married couple filing separately. What most people do not know when it comes to this primary residence exclusion is this part, which is the widow and widowers who sell within the first 2 years of the spouse's death. So, if you have parents and one of them passed away, and your mom or dad continues to live in that house alone over 2 years, they lose their married filing jointly exclusion. They become a single person. So if that is something that's important to you, you gotta move mom into her own apartment, you gotta move mom into your house, whatever you do, but you gotta sell within that 2 years if you want that exclusion. Otherwise, she becomes a single person. Anything over $250,000, and if they lived in that house in Mililani for 30 years, they got more than $250,000 in capital gains. So with that being said, she's going to be treated as a individual.
Yeah, but what about the stepped up basis? What about there's the stepped up basis, so.
But did they move every 2 years and just do it in 500?
Oh, you mean this?
Yeah.
Most of the time, so, okay, so that's a good question. That could be a loophole if mom wasn't already on the house with them.
Oh.
Meaning, if dad owned the house by himself,
Oh, okay.
and then he willed it to mom,
Oh.
then she inherited it, that would apply. But if they were on the house together and took title as tenants by the entirety, which most family couples want because it gives you added protection against the IRS and liens, then technically she didn't inherit anything. She was already part of the transaction.
So you don't get the stepped up basis?
No.
Really?
Not if they were tenants by the entirety.
Yeah.
Nope.
Wow.
Yeah.
But if it's a trust, you would get it?
If she was never affiliated with the property in title at all, she would get it.
Never ever.
Never ever. Yep.
But why would she do that? Because
Yep. Yep. And sometimes that happens, right? Sometimes I wish I married a rich guy and he just took care of everything. so sometimes it may happen that way. But generally, at some point, in order to protect the entity, they're going to take title as tenants by the entirety. And in that case, it's not inheritance. She owned it all along. So she would not get the stepped-up basis.
Wow, I didn't know that.
Yep. Yep.
Oh.
So 2 years. 2 years if you are widowed. Okay, 2 years.
Wow, I didn't know that.
Yep. Yep.
Oh.
So 2 years. All right, so going back to the real estate agent that built an entire empire by moving his family every 2 years, you can use the exclusion every 2 years. But don't count your ducats too soon. 2023 is a new year for us. They're going after this too, right? They're going after this, and they're going after your 1031 exchange, right? Again, exactly.
Again.
So if you have a 1031 exchange and you're thinking about doing one, 2022 is your year, okay? If you have investors that are looking forward to it and they say, I'm gonna wait till next year, remind them that it may or may not be there next year, and the benefit that they're looking to seek may not be there next year. They're looking to diminish that because obviously the IRS wants to keep more of a chunk. And same thing them, that they know that people are leveraging this guideline because that's what IRS guidelines are, right? And that's what your CPA does, is he looks for your little loopholes, and once you find your loophole, then you can go after it and live within those loopholes. So that is one of the things that the IRS is going after, is identifying the loopholes and trying to find a way to close them, or at least minimize them so that it offers less benefit along the way. So this is one of the things that they're going after. And the exclusion does not apply to vacation homes. It only applies to the homes that you're living in. Okay, so let's talk about how that works. So if you have $1 million sales price and your cost basis was $250,000 and then your cost of sale was $6,000, because remember that becomes a part of your basis, and then minus your primary exclusion if you're married, that means your taxable gain is about $190. And then if we go with that average capital gains rate at 15%, then that would be your capital gains rate, which is much better than if you were paying it on $690,000, right? So, so obviously you can see how powerful that exclusion can be when it is applied. Okay, conversion, rental to primary. So this is what it would look like if you rent out the property before you live in it as your primary residence, okay? And this is a calculation that your CPA will perform. So let's say you purchased it in 2010. You rented it for 8 years, which is 80% of your ownership period because you held it for 10 years. Then you move into it as your primary residence, and this happens a lot. This happens a lot in things like divorce, right? We bought a property as our primary residence. We never thought we were going to live in it, but now the husband doesn't have anywhere to live, so he's got to go live in the rental property. So this happens a lot, and we see this a lot. And then so 20% of your rental period. So when you sell it, because you rented it for the first 8 years, you can only exclude 20% of the gain that you would have realized. Okay? So
But you could do a 1039.
they're going after that too.
Yeah.
Exactly. They're pretty much going after everything because capital gains the last few years have been very lucrative, and they know that, and the IRS knows that they have lost a lot of money to the loopholes. So once again, they're going after all of this stuff.
Because they don't make anything, they haven't lost anything, they're stealing our money. I mean, really.
Judy, what do you mean of the primary, rental into primary? You move into it, it's a rental, you move into it after 8 years?
Yeah,
Then you sell it?
Yeah, so kind of like the example that I gave you. So husband and wife buy the house,
Yep.
right? So they live in Mililani and they bought a tiny condo in Makiki, right? Right on like Pensacola Ave, because I think that everybody needs to at least live in that condo on Pensacola Ave the first couple of years of your life. But anyway, so they purchased it. They had never had any intention of moving to Makiki. But now they're getting divorced and the husband doesn't have anywhere to live. So then he says, you know what, I'm going to get rid of that tenant. I'm going to move into the Makiki place. So now he makes it his primary residence. Later on down the road, they get divorced. She makes off with the house, he makes off with the condo, and then he sells that condo. He can't take the whole exclusion. He can only take 20% of it because they rented it for the first 8 years of ownership.
Plus he has to recapture on the depreciation, and you've
Yep.
got that whole mess of a calculation.
Exactly.
But he could do a 1031 if it's within a certain period of time, right?
Not if he's living in it.
He's already converted it,
It's already converted. Yep.
so you can't do a 1031.
Yep.
Oh.
1031 exchange is only for investment properties that you are currently not living in. And it would have to be that you haven't lived in within the last 12 months. So if he had moved into it as his primary residence, then he went and got his own house and moved in there and then rented it for another 12 months, then he could do a 1031 exchange.
Providing it's still on the books.
Yep, exactly, provided it's still available. Exactly.
Yeah,
Yep, but that's how that works.
so far.
Okay, and then this is an example of what something like that might look like. 600,000 purchase price, 100,000 basis, $500,000 gain. Okay, and then this is an example of what something like that might look like. 600,000 purchase price, 100,000 basis, 500. And then at the 20% ownership period, because of the calculation, he'd still have to pay 400,000 in taxable gain. Yep.
Might be more than that because of the depreciation recapture.
Yep, exactly. I'm gonna call her the bearer of bad news. She's
calculation.
I'm just kidding. Okay. It's true though, it's true, it's true. And that's why I promised you at the beginning
That's
of
a
class
lowball
that, I'll
number,
try not to
trust
make you fall asleep in the beginning, but I'll try not to live in your nightmares after this. That's why it's perfect for Halloween time, right? So if you want to scare somebody in Halloween, don't dress up as a ghost, dress up as an IRS agent. Okay, conversion. I think you just get a name badge. So conversion, primary to rental, okay? So if you purchased it and you lived in it for the first 8 years, then the calculation is reversed, okay? So if you lived in it for the last 10 years, and you lived in it for 8 years, because remember, you have to, per the guideline, you have to live in it. Boop. Must live in home 2 out of the last 5. Okay, so let's go back. Must live in home 2 out of the last 5. Okay, so let's go back. Must live in home to this one. All right, 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 so this one, you purchased your home, you lived in it for the last 8 years. Once again, 10-year ownership. Then you rented it for the last 2 years. Even in that situation, because you lived in it the 2 of the last 5, because 2 and 3, then you would receive your full exclusion. Okay? So that's really where you want to be. So how do we, if the guideline stands next year, how do we beat this guideline? Well, we can live in the home, and then up to 3 years you could rent it, right? And then you still meet that 2 out of 5 situation. But after that, you lose your full exclusion and you have to perform that calculation. Yeah.
And you gotta recapture depreciation. Or do a technical exchange.
Exactly. Okay, and now that you feel like it could not get any worse than you could imagine, it gets worse than that. All right, so what people don't know and they do not talk about, okay, is that on top of the capital gains calculations that we just performed, there is another tax called a 3.8 net investment income tax. And that is the capital gains on the sale of a primary residence in excess of the exclusion. So once again, it hits your capital gains again. Capital gains, and it hits the capital gains on sale of a vacation home or an investment property. Because remember, the exclusion only works for your primary home. So so whatever you sell your primary home at, whatever that taxable gain piece is on your primary residence, that will get hit by another 3.8%. If you're selling a vacation home, remember you don't get an exclusion, right? It does not qualify. So you get hit for your full capital gains plus the 3.8, and then same with your investment property, you get hit with full capital gains plus another 3.8. So that is why it's showing here that average number plus your 3.8. So that's why when you talk about what does capital gains really mean, and it seems a little fuzzy, that's why, right? Because it depends on your tax bracket. It depends on if you are taking the exclusion or not. It depends on whether it's your primary residence, your vacation home, or your investment property. But whatever that tax is, you still gotta add 3.8 on top of that. And that's another thing that the IRS is going after. They're trying to increase this rate.
Yeah.
Yeah. So,
Guys, vote R this time, don't look for the damn D's.
so yeah, so that's why when people talk about capital gains and you hear someone say, I had to pay 40% in capital gains, that's why. Because they're already at a high tax bracket, they got hit with their capital gains plus the 3.8 that they didn't know about, that their CPA told them about when they filed, and then they said, oh gosh, that was so much worse than I thought. So, so yes, this is all the different things that go into that.